Well, thanks everyone for joining us on today's episode of Investing for Generational Wealth. Appreciate your patience also while we sorted through some technical difficulties. And today with us here we have Kay Singh. KK, I believe we've spoken. It's probably been a few years though, but would love to hear about your journey again for those who are just tuning in now, and we can dive into the fabulous presentation you have for us.
So thank you. First of all, thank you very much for having me on your show here today. So I really appreciate it, and I've been looking forward to it. And it's going to be a great show today. So I'm going to start with my little journey through all the hoops that we have been. So I came here from India in actually I came here in 1997 and then went back and came back in 2001. And by the way, my name, this KK is an American name, but my full name is Kay Singh. So I came back with my family back in 2001 and started the American journey. I started at working for an IT company, and I am Microsoft certified system engineer. And I lost my job after 9/11, and then I accidentally got into the gas station business because my friends were in the gas station business. And instead of going back or trying to find another job, I jumped into the gas station along with them, and been in the gas station business for 23 years. And I have been in some other business, laundromat, dry cleaning, event center. We have all. So now, back in 2015, I along with my partner, we bought 40 single family houses and started the journey of a landlord, and I started managing it myself. So to learn the business, because the guy who sold me the business was also from India and was from our community, but he was 82 years old and he was all old school. He did everything with pen and paper, which I couldn't do because of my other businesses and my technical knowledge. I was a computer savvy, so I didn't have to go through that route, and I didn't have that much time. So after buying those and getting my feet wet in the landlord business, I soon realized that it would be great to move on to the multifamily space rather than being in the single family space, because when we bought 40 houses together, so we were getting a lot of other deals. Somebody had 2, he wanted to sell. Somebody had 5, he wanted to sell. But I decided not to go for any more single family houses because there was a lot of pain with the single family. So I decided to start investing in the multifamily with other operators. And at that time, we had like 8 gas stations and we had a couple of other businesses as well. We had a laundromat as well. So at that time, I thought, okay, it would be nice to just invest with other people. But after my first investment, I realized that I need to learn the business. So I joined some courses, I attended some boot camps, and I read a lot of books. It was not like owning a gas station or managing 40 single family houses. It was totally, the multifamily space was a totally different animal. So I decided to learn, and I also joined a mastermind where I found my first partner.
Which mastermind did you join?
I joined Rod Cleve's mastermind.
Okay.
and there were a lot of great people in that group. And it was in San Diego. Our meetup was in San Diego, and I had Jeff sitting next to me, and he was waiting for some more capital to close the deal. So he asked me if I could raise 500,000 in 3 days. So I thought, okay, I'll jump on it and I'll give it a shot. And I raised 550,000 in 3 days, and they closed on the scheduled closing. So they did close that deal. And after that, the doors opened for me on a bunch of deals because I knew a lot of syndicators from there. So I picked up some great operators and worked with them.
And fast forward to today, where are you in each of the businesses that you own?
Okay, so today I was invested in 17 deals, including my general partnership and limited partnership. And I even lost the count. There were over 5,000 units as a LP and a GP both. And we have done 9 deals as a GP. And on the first couple of deals, I was only a capital raiser. But after that, I actively started participating in the deals, signing loan, putting my earnest money down. So after that, I've never looked back, and I always get calls from good
I just lost you there. I don't know if it's me or if it's just me.
It could be me. It could be me too.
Okay.
It could be me
Um,
too.
but I think the last thing we heard you say was earnest money, like you started signing on as a GP
So after, let me turn off a few of the other browsers that I have on, so that it could be me too. So I just started. I normally start my browser just before, no, not the browser, the router just before our meeting, 15-30 minutes before. I always do that so
Okay.
that we don't have any problems. So anyway, so I had invested in 17 deals. 9 of them was as GP, and 7 of them was 8 of them was as a LP. I invest in every deal that I do as a GP. So I was invested in 17, and out of that 4 we have sold. So we still have 13 deals, and out of that 9 are as a GP. And we do large properties. Most of our properties are over 200 units. So we have about 2,800 units, and actually we are closing today in Kansas City.
Congratulations.
Yeah, thank you. So we last year we closed on 2 deals, 2 properties in the same portfolio, and the third was an assumption of loan. So it was a hard loan at 2.8, so it took us about 6 months to close.
Oh, yeah. I've heard HUD loans are a nightmare.
Yeah, it took us about 6 months. So we are actually closing right now as we speak.
Cool. Well, I'm sure there's going to be a lot more questions from myself and from the audience. So let's get into what you look for when you're analyzing, these 200, 300, 400 apartment buildings.
So let me give you an explanation how it works. So I'm not a professional underwriter, but I coached for Radcliffe as well. So I know a lot about underwriting as well. And I'm going to go over the key metrics that we look at. And how it works is other operators present their deals to us. and then we go over the underwriting, we go over all the aspects of the deal, and then we decide. I'm a kind of an independent syndicator, so I'm not tied to one company that I will do. So I've done 9 deals with 4 different operators. So they present their deals, we go over it, and we see. We sometimes put it into our own calculator because everybody uses their own templates. So sometimes we use our own template to see where this stands and how the deal looks like. So we go by the calculators they provide, and if we need to, we have our executive manager put all the numbers into our calculator, and then we look at. But I'm going to go over. I'll have to share my screen, and I can go over the key metrics that we look at when we underwrite our deals.
Okay, that sounds good. And before we do that, let me just start live. I forgot to live stream to our Facebook group. So
And they can, if you want me to answer their questions, I can answer some questions before, if they have some questions about what I talked so far, and then we can go over the underwriting and they can ask us questions at the end.
yeah, I don't see any questions so far in the Q&A, but again, folks in the audience, feel free to throw them in the Q&A or raise your hand or, message them to me, and, we'd be more than happy to cover them. But yeah, let's get started.
All right, can you give me the power to share my screen?
Yeah, you should have it.
Okay. Oh. Can you see my screen now?
No, I can't.
No? Okay.
No.
Okay. Now, I think now
Yes.
you can.
Yeah, now you're good.
So, all right. I'm going to go over all these 15 metrics that we look at. And we do look at some other things as well, but these are the most important metrics that we look at when we look at the any underwriting. And people sometimes send me underwriting just to look how the deal looks, and sometimes even people send me to invest with others. They send underwritings and their OM to tell me how the deal looks. So, I mean, I have certain amount of time I can do that. Certain times I can do, some certain times I can't. But these are some of the main things. First of all, and the most important.
KK, before we get into the numbers, we
Mhm.
do have a question. How do you identify the right area to purchase a multifamily property?
Okay, so we have some. That's a whole new presentation. I can go over that as well.
That's true.
So yeah, so we look at so many things where to invest. So we go, first of all, we go only to the landlord friendly states, and then we go to the primary markets. We will go out of the primary market. For example, we have a property in Maitland, which is a suburb of Orlando. We don't go far away from the bigger cities, and then we look at the job growth in that market, and we look at so many other datas to decide which market we can go and buy property.
Okay. And
We look at the rent growth of that market, and the historical rent growth, the job growth, and what things are coming. We don't buy properties in smaller cities. And the second thing, we do not buy properties where there's only one big employer.
yeah,
And we don't buy any properties where the states are not landlord friendly.
one thing
Does
that
that does that make sense?
It does. I think one thing I'd also recommend to the audience is pick up a copy of Joe Fairless's book, The Best Ever Apartment Syndication Book. And he goes into depth on an exercise of picking markets and all these factors to consider, like KK was mentioning, landlord friendly, job growth, population growth, etc.
And Keshav, if you want, at the end, they can contact me because I coached, so I have a whole list and everything where they can find, and even not just the market, they can also research the sub market. And I have links in that. It's a Word document. I have all the links where they can click and go to that particular site and check the data. And most of them are free. You don't have to subscribe for.
Okay.
Most of it is free.
Yeah, we'll definitely include your contact information and whenever we post this, and I'm sure you'll have it up on screen as
Yeah,
well.
I can share those documents with them.
Yeah.
So, guys, the net operating income is the most important metric that you need to look at when you are looking at any underwriting. And I figure that all of you must know what net operating is, net operating income is, and how it's determined. So it's the operating income, revenue, total revenue minus the total expenses. It's an easy thing. And every underwriting has that, every financial has that, whether it's for any other business or multifamily, like any other business in multifamily, the expenses are on the top, the expenses on the bottom, and then we have the net operating. It does not include, so keep this in mind that it does not include the mortgage payment. So mortgage payment is further down.
Yep. Typical terminologies in the industry is above the line, right? So what
Correct.
items are above the line, you count those expenses in calculating the NOI, and then other expenses are below the line, like KK said, more, your debt service, and that you don't count in calculating your NOI.
Correct. So the next is cap rate. What cap rate are we buying the property at? And the cap rate is calculated by dividing properties NOI. And you'll see NOI in every slide, I guess. So the NOI by its current market value. And you can also fix, and a lot of people ask me, where do you get the cap rate of the market? And it's not fixed. It's not that it's Miami is 3%, Orlando is 4%. So it also depends on the property, the age of the property, the status of the property, the occupants of the property, and when it was renovated. There are so many variables, but it ranges between 100 points. So if you nowadays A, B, C, they used to have a big spread, but nowadays there's not much difference. Nowadays it's not more than 100 basis points. So 1% difference. If A class property is at 3% cap rate, B class would be 4, C class would be 5 maximum, or 4, maybe between 1%. But initially, several years ago, when I started in this business, there used to be a little bit more spread at that time.
And an easy way to think about cap rate also is just how attractive a property is. I think the lower the cap rate is, the more attractive the property is.
The more pricey, the price is going to be more.
Yep.
And also it can be obtained from calling a few brokers. Easiest way is to call brokers and see what cap rates the properties are trading in that market. There is no fixed cap rate or anything these days. So cash on cash return, that means this is also an important, and the investors love to see this. The operators also love to see this cash on cash return. We want to make sure that we get the right return on our investment, the money that we have put in. So this is one of the very important metrics that we look at when we underwrite our deals. So to do that is dividing by annual cash flow divided by the total cash invested in the property. Debt coverage ratio. This is a bank term, DSCR, a very common term for the banks, and banks want to make sure that this property is going to pay off its debt. So when you underwrite any property, you have to see that it is above 1.25. Normally 1.25, that means if there is, let's say, $100 mortgage payment, I'm going to give a very small number just to understand. The cash flow of the property has to be 1.25. And in the last couple of years, even the banks would give you a loan for less than 1.25, but 1.25 is the general number that the banks like to look at.
And just to clarify, when you said 1.25 earlier, if the mortgage is $100, then the NOI has to be $125.
Correct. Actually, the cash flow has to be
Or sorry,
cash flow has to be $125.
Yep.
So banks want to make sure if there is a little dip or something, you still will be able to pay the mortgage payment.
Yeah.
Okay. Occupancy rate. I think everybody knows what occupancy rate is, but this is also very important when you underwrite. So if it's like at 60%, it's hard to get a loan. It's a heavy lifting, and then sometimes it doesn't even make sense to buy the property unless you're an expert in renovating the property, heavy lifting and raising. But sometimes these low occupancy properties make you good price, the good money, and you can get a good price on these properties.
What do you typically look for in occupancy rate?
Well, the way we do deals, we look at around 90%.
Okay.
Yeah. So not that we won't buy less than 90%, but we look around 90% because it's very easy to get the credit if your property is 90% occupied for 90 days. So you can directly go to agency loans. Agencies that look at that 90% number. And the type of properties that we buy, they're always above 90% occupied. So average rental rate, this is also something that we look at. We want to see, I mean, sometimes people are there for 5 years and you can't just tell them to leave or just push them out. So you have to increase the rent slowly as compared to the newcomers. So then we have to on every rent roll statement has different rents. So you have to figure out the average rental rate for the property as a whole.
One quick question we had, on occupancy rate is if occupancy rate's very high in the area, but what if occupancy rate's very high in the area, but for property occupancy rate is low and you can get a good deal?
Yes.
That's a question.
Is that the question?
Well, that's a question. What if occupancy rate?
Yeah, that's what I said. So
Right.
let's say somebody has 100 unit and he's 60% occupied, and for the last 6 months or a year he couldn't increase the rate. So these properties are bought on net operating income. So whoever is buying, he's going to look at the NOI and then the cap rate to purchase this property. But the properties that are newer, sometimes they are not like 90% occupied because they are still renting those units and they are giving concessions, but the properties are new, so they go by performa. So a lot of times brokers make the performa that this unit is rented at, let's say, $1,000. So they multiply the rest of the units at the $1,000 as well. And then they take 5% off. Okay, let's say we have 5% vacancy. So that's how you have to make some assumptions.
Okay.
So the operating expenses, normally we would, in our underwritings, we would take their operating expenses and then we work out our numbers as well in the underwriting, because they might, you got to go closely on the operating expenses, because maybe they just didn't pay attention to the prices, or they didn't do a good job managing the property or the manager property, or they're just paying over over expenses which you can reduce. Let's say they have 5 people on 100 unit and they're paying the payroll, and you go in, you want only 3 people, you don't want 5 people. So once we get the operating expenses of the seller, we put it in the calculator and then we assume that how much we can run this property with.
Okay. And before we move on to the next slide, one thing I just
Sure.
thought of is,
Sure.
would you be open to sharing the model that you use? Like maybe on the screen right now, if, while we're reviewing these concepts, if we could see where in the model they
I
are.
don't have on this computer because
Okay.
I'm in my studio,
Okay.
but I can email you.
Okay. That works.
Yeah. And I have about 20 of them.
Why
So
so many
because,
models?
and why we have 20, because a lot of operators keep sending us, but the one we use, the one I use is very simple, and it is made by David Tupin. So it has two versions. It has two versions. First version is that we underwrite it with the first version, which is easy. And if that makes sense, then we'll move to the second version. Otherwise, I'll leave it there. If it doesn't make sense in the first version, because first version is a lot. So for example, the operating expenses, there are like 10, 15 lines in the T12, which shows the expenses, will show water. So instead of writing all the things separately, I'll have 2 or 3 categories only. So for example, water, gas, um, electricity, I'll put everything in one where it says utility. So it's much simpler calculator that I use. And if the deal looks good on that, then I move to a detail one. Otherwise, I'll leave it there. But I can share it with you.
Okay.
And David Tupin, he's gone to the third version now, and that is online. So he's gone to the online. I don't have the online version, and I looked at it. I don't think it's any better than the one that we have. So I didn't invest in that, and that cannot be sent to me by email because it's an online version.
Gotcha.
Okay, so loan to value ratio. This is again very important, and this can be checked with the creditor. And like these days, loan to values have gone very down. So now it's like 60-65%. And previously, and it depends who you are getting a loan from. So it could be If you are getting a HUD loan, it could be 85% LTV. If you are getting a private loan, bridge loan, it could be 80%. If you are getting an agency loan, it could be 60%, 65 these days. We refinanced a property in Orlando. We got 59 LTV. That means we had to come up with 41% of the money. So normally people think, oh, it's 80-20 like when you buy a house. So it's 80-20, but in the multifamily space, it's variable. It keeps moving up and down, and the market gets tight. The creditors decrease the LTV ratio. So I hope everybody understands what LTV is when you buy a house. If you are putting, let's say you buy 100,000 house and you're putting 20% down, that is 80% LTV. Market trends and demographics, and I spoke about a little bit. So we also look at the market trends, where people are buying, what market is hot, and is there a population growth, is there a job growth, and demographics of what kind demographics are. There are several websites, and the best one is census.gov, and all others get their data from census.gov. So you can directly go and get all this information for free. But some websites, they make it look nice, colorful, and they charge you for that. But census.gov is a best website that I have seen and I used, and a lot of these companies get their data from there and put them in colorful charts, etc., just to charge you some money, just as people are doing with AI, ChatGPT. So they are charging you for the apps and all that, but they're still getting the same data. So reserve funds. So I hope everybody knows reserve funds, what we need these funds for. And sometimes the creditors make you do that. And the standard for this is about $300 a year for a unit. And sometimes the creditors make you put a little bit more. So you have to calculate this in your underwriting, that you are keeping reserve funds, at least 300 per unit per year of the reserve funds. So that has to be built into into your underwriting as well. Again, rent roll, we went about the rent roll. Normally, your property manager, the type of properties we do, our would-be property management company, they come and do this rent roll analysis. They want to make sure that whatever it says on the lease is correct, and the income is coming, and there is a tenant. And I have seen horror stories. Sometimes because they want to sell it and it's 90% occupied. Now 4 of the tenants moved out, and they want, at the time of closing, they want to show that they have 90% occupancy. They have to provide the rent roll at the time of closing, and sometimes they just pay rent themselves for a month or two just to keep the occupancy over 90. And I have heard some stories like this. Not very common, but anybody must do the due diligence. When they do the due diligence, physical due diligence of the property, at that time, if the property management is not done, they should do it themselves. So they should get a detailed breakdown of these rental income and separate from the other income. And I think everybody provides this, but there are sometimes companies that don't provide the detailed rental income, and those are shady companies, I would say. So tenant retention rate. And this is also sometimes you get the right information, sometimes you don't. So when you do your underwriting, your numbers should be based on the retention rate. So if 10 people are coming up expired on their leases are expiring next month, how many of them are going to stay? And you can calculate the rate for the whole year, and it should be over 50% retention rate, at least over 50%. Gross rent multiplier. This is again a technical term, and it's calculated by dividing the property purchase price by the gross rental income. And gross rental income includes the rent, other income as well. Yep, so it is good for comparing relative value of different properties in the market as well. You can do that too. And there are some online websites where you can get the data of the other properties as well. Does that make sense, Keshav?
This does, yeah. That's actually not one that I've, heard of all that much, but it's good to know.
Yeah. Environmental and regulatory compliance, and this is a part of the due diligence as well. And this must be done. And also, I would add one more thing here. I think I don't have that on the slide. And since it's with the government, the environmental regulations with the government, and you must also check the property taxes and how the counties, each county is different. Some counties have a flat rate increase, some counties increase the price based on the purchase price, and some counties, for example, here in Fort Wayne, Indiana, they can't raise the, even if I buy at double the price than the previous buyer, they can raise only 3% value of the property. They can't increase. So that's another thing. Property taxes, you must check with the city when you check these environmental regulatories. You must check with how they increase the property taxes in that particular county. And I'm going to speak on this here a little bit because I have gas stations, laundromats. So um, on these properties, and it could differ from county to county, city to city. So the easiest way to do is to get a phase one examination. So there are a lot of environmental companies, and that's the cheapest one you can do is the phase one. So if something comes, they will recommend in the phase one to do a phase two examination. In the phase two examination, they will bore some bells on the property, and then they'll be able to give you much more details of the topography and all the, if there has ever been a gas station on that property or leakage or next to a gas station or something else, or even next to a dry cleaning place. So those are the things that need to be, and they don't go away, guys. They don't go away. And so this money spent on the environmental, getting the environmental checkup is really good investment. Because if after a year or two, you start smelling gas or some other perk, perk is a chemical that the dry cleaners use, so then you are in trouble. Your insurance may cover or may not cover. Exit cap rate. We talked about the cap rate in the earlier slides. So now we can talk about the exit cap rate. So exit cap rate is the cap rate when you sell. At what cap rate you exit the property. And I'm going to give you an example. So let's say we bought the property at 5 cap rate, and after 5 years, we sell this property at 3 cap rate. So that means the cap rate went down, the property value went up. But if you are selling instead of 5 cap rate, you are selling at 7 cap rate, that means the value of the property is going to go down. So it's based on, so when I have seen in a lot of underwritings, by making 25 basis exit, normally it used to be 1%. So if you go in at 3% cap rate or 4% cap rate, the exit cap rate had 100 basis points difference between the going in and exit cap rate. That means we are assuming if we bought it at 5%, we are assuming that we will sell at 6% to be conservative. But in the last couple of years, I have seen the spread went down from 1% to 25 basis point. That means 1/4%. 25 basis is,
When was it 100 bips? I'm curious.
well, when I started investing back in 2015, I always saw the cap rate 1%, exit cap rate 1% above.
Oh, okay.
But in 2021, I started seeing it went down to 50 basis point, and then it went to 25 basis points. That means 1/4, only quarter. So if they went, because the people do this just to make the deal look good. So by changing, if everything is good and you are okay with every other metric, and you just overlook the exit cap rate by if changing by 25 basis points can make a bad deal into a good deal. So a lot of operators do that purposely to make the deal look good, to make 2x or so 2x equity multiple. So let's say by underwriting properly and with 50 basis point or 75 basis point, the deal is at 1.67, and they won't change anything. They will change just the exit cap rate. And who knows? Nobody knows what the cap rate is going to be in 2 years. So this is an easy trick to make the deal look good when they change the cap rate, exit cap rate by 25 basis points. I think that is it.
Okay. Great. Well, thank you for that crash course on some very important underwriting metrics. So for folks in the audience, now is the time we'll open it up for Q&A. While the Q&A is coming in, one question that I had was how you typically look at internal rate of returns and yield on cost for multifamily.
Well, it's a part of the underwriting too.
Well, what do you
And
typically target, I guess, on?
oh, we target between 15 and 18.
Okay.
And at 18% IRR, the deal looks good. The equity multiple is 2x with 18% IRR over 5 years. And that's what we look at. And I have seen about 20%, 22%. They're not conservative.
Well, we could
So,
see that coming up here over the next, year or so, right? With all the distress.
well, even if they are, why would the operator want to give you 22% when people are ready to invest for 15%?
Maybe they should really care about their investors.
No, they tweak the calculators, because if I can, let's say I have to raise 5 million. If I can raise 5 million with 15% IRR, why would I want to leave money on the table?
Yeah.
So they'll tweak somewhere to make it between 15 or 16 or 17. Either they can add some fees. They can add some fees like asset management from 1%, they can go to 1.5%, or they can change the exit cap rate or something to look good. And I don't think the time is going to be such that that we will get 20% IRR, 22% IRR. I don't see it.
I guess, how good do you see it getting then?
I think the maximum, the real, if I want to show it 25%, I can easily,
Yeah.
but it's not realistic. I think realistically, we might go to 20% IRR.
I mean, we'll still take
And
any day of the week.
yeah, and also if you see, when I started, there was 9% preferred return. I still have some deals that I get 9% preferred return on, because not a lot of people were investing in these deals at that time when I started. And slowly, when a lot of people started investing, then it went to 8%. And there were no waterfalls. There weren't any waterfalls. Do you know what waterfalls are?
Yes. What do you mean there were no waterfalls? Like there has to be a
So there was, in my first deals, there was a straight 70-30 split
after the pref.
after the pref.
Yes.
70-30 split.
Yes.
So once it's starting, people started investing in the deals, a lot of gurus came over, and then they started doing the waterfalls. So then they said, okay, after 18% IRR, we'll go 60-40 instead of 70-30.
Yeah.
And then slowly it started coming to 12%. At 12%, they're going to go 50-50 because there was flood of money in the market. Everybody was investing. Everybody had had a lot of money, and the capital increased by 26% in 2021. The the capital in the market went up by 26% with all these EDLP loans and all those free money, helicopter money, and the PPP. So there was so much money, and then the preferred return went down to 7%.
Yeah.
So I don't see any deals yet with the 8% preferred return. So it's not turning up. It's still at 7%. People are still underwriting at 7% preferred return. And also, in the first year, they can't even pay 7% because they are overpaying upfront.
Right.
So still, people are raising capital.
Do you see any operators out there ever hitting their pref before selling?
Hitting their pref?
Yeah,
Oh,
before
we
sale.
out of 9 properties, we on 7 properties we are paying our preferred return of 7 to 8%. So
Oh,
on the earlier deals we had 8%, and some on the out of 9 properties we have been paying on 7 of them.
that's good.
But we have done this too. In the first year we paid only 5%, and the second, third year, following years we got up.
Yeah.
When the market does this, everybody has to do it because otherwise you won't get a deal.
Right.
So people were overpaying in the last after the COVID, people were overpaying on the properties. So with this slowdown, it changed a little bit.
Out of all the businesses that you have, right, the laundromats, gas stations, I think you said event spaces also, and multifamily and any others we don't know about, which one is your favorite?
Okay. So these are two different animals. Businesses, you got to get involved. These are investments. So multifamily is an investment as compared to laundromat or gas station business. I have to go there every day. I don't have to go to the property every day. I go there quarterly.
Oh, gotcha. And you're
So of course, this is an investment. It's much easier, and the properties that we don't have our own property management, so we don't have to spend a lot of time. So we have weekly calls, and I think the easiest one is the multifamily.
gotcha.
But of course, we make more money on the businesses because we are spending time in the business day to day. So it's much more lucrative, but these are two different animals. We can't compare an investment to a business.
Right. I was under the impression that you were operating the multifamily as well, but it sounds like, yeah, you are just investing.
Yeah.
Right.
So I'm not key sponsor on any deal. So I partner with other operators and they are responsible for everything. I just get on the calls once a week.
Yeah.
I do put the money down, sign a loan, but I get on the calls every week, and I have access to the ERD where I can log in and see the rent roll, etc., everything. I spend about, I would say, about 9 hours a week on multifamily.
That's pretty good, yeah.
Yep.
So as far as underwriting multifamily goes, I know some of the mistakes we talked about were watch out for cap rates, cap rate manipulation, right? Don't always make sure that your exit
Correct.
cap rate is higher than your entry. And
I would say at least 50 basis point, but if not, I mean, you don't want, of course, you don't want less than, I mean, a lot of people call conservative underwriting, they are not.
yeah,
And the second thing, a lot of people make mistake, they don't check the property taxes. They don't, and it gets surprise. And insurance agents should check with, get a quote from the insurance agent as well. Sometimes you never know. There was a fire 2 years ago. You don't know of that. And they filed a claim and got a claim. So the insurances goes up. So also you should get an insurance quote.
okay. Well, you did a good job of preempting my question because my question was going to be, what are some other things that we can do to be safe with our underwriting?
I can go over some others if you want.
Yeah, sure. Just like two or three more.
Yeah.
Top mistakes.
So sometimes
I guess your internet connection doesn't want us to learn about safe underwriting, or maybe it's mine.
like
Oh, we just
and
lost you. Like we didn't hear anything.
oh, we lost. Okay, I'm sorry.
Yeah, yeah.
I'm sorry. I'll go over again.
Okay.
So another thing is sometimes I have seen in the underwritings as well, people would put the operating expenses in the capex section because capex is not counted in the NOI. For example, if I had a water heater or an air condition repair, they would put it in what in the capex section. That way, the expense is decreased and the NOI goes up. Yeah, and definitely go through word by word. I would go through word by word, each section by section. Anything that looks awkward. So let's say you get a uh, T12 from somebody, and you go through monthly on all the 12 months. If you see like everything other is about $1,000, and here it goes 15,000. There is a red flag. Why did it go? And also go by the capex. And you can always ask for a capex list as well. So if they instead of changing the whole roof, if they put it in repair or the vice versa, then they can put it in the capex, and that will decrease the expenses and increase the NOI because they just allocated a different category to it.
Gotcha.
Yeah, so people play games in that as well. I see that in T12s a lot, a lot. So
Yeah.
they move the expenses, the operating expenses to the capex section. I've
Well,
seen that.
with what we're teaching people here, hopefully no, they won't have anyone else left to fool. So that's the goal.
Yep. So our goal is to educate your viewers what we look at so that when they look at these things. So, Keshav, let me ask you, are your viewers mostly operators or investors?
I believe they're mostly investors.
Okay,
I
okay.
think,
So
yeah.
even if you are investors sometimes don't get to look at the underwritings. A lot of sponsors won't share the underwriting with them, with the investors, but they can always ask for more details based on what I said.
Would you say that's a red flag if investors asking for the underwriting and the sponsor doesn't provide it?
No, that's not a red flag, but to be honest, not a lot of syndicators want to provide because and there are sometimes there are genuine reasons for not doing that too. And the genuine reason is sometimes the investors don't know what they are looking at because these calculators are so complex that not everybody will know, and they might not invest because they didn't understand.
Right, that's true.
So that's one reason. And then the second reason, they can also see how much fee they are going to make, how much the syndicators are going to make. That's another reason they don't want to share. And if they delete that part, then the whole calculator will be messed up.
Yeah.
So that's the one reason they don't want to share the calculators. Like the if you are doing a business, if I have gas stations, if somebody as when we are selling candy, if somebody wants me to provide me the invoice for the candy, why would I do that?
That's true.
So same way, most of the syndicators don't like to provide the underwritings to the investors, and I don't think 90% of the I have I have done this a lot of times over the Zoom call. I have shown them everything because if I just send them, they may not understand something. They might just misunderstand and say, no, no, I'm not investing. So I have gone over the underwritings with my investors a lot of times.
Yeah,
I
that's
ha
hard to do.
I have a group of doctors here locally, and they are my investors. And I go over every deal. I go over the OM first, and then I go over the calculator to tell them where these numbers came from, because the OM is based on the calculators.
Okay. Cool. Well, with that, we are at the top of the hour, so that's it for today. But we'd love to have you back on to maybe a part two for underwriting or even market research, like we alluded to earlier. So,
Yeah, if you want some other day, I can go over how to, just as somebody asked a question, how to find a good market and a sub market.
yeah,
I can do that.
yeah.
Yeah, I have all the documents, etc. for that, and I can show them exactly how we find the good market and a sub market. And sometimes, for example, we let's say we have a property in Indianapolis, but sometimes there are some markets you don't want to go into. So we don't just go into the market, then we research the sub market as well. And I know how to research the market and the sub market as well.
Yeah.
I used to live in Indianapolis and had a gas station and 46 and Keystone. And during the day, it was the best. Keystone was the best. And as 5 o'clock, 6 o'clock, it was the worst. In 6 months, we got robbed 5 times.
Oh, wow. That's not.
So we had to hire a security guard. So sometimes the markets for the multifamily are the same way. On the west side of the highway, it's a really nice neighborhood. On the east side, it's a really bad neighborhood. So if you say, oh, this is Atlanta, but you don't know this side is dangerous, you don't want to go into a war zone. But on the west side, it's a nice neighborhood. You can easily go. So you have to do research on the sub markets as well, and anybody can do it. It's not rocket science. There are free websites, and I'll provide you those documents.
Yeah.
Just click that, go to that website, enter the zip code, you'll know. And it will give you like a little piece by piece. This is a good piece. This is good. This is not good. So, yep.
Okay. Cool. Well, thank you for
Okay.
taking time out of your schedule to speak with us today. And we have your contact information up here on the screen. So folks, feel free to reach out to KK to learn more about what he does. And I'll send you a recording of our webinar here as well so that you could distribute to folks that, you'd like to see.
Sure. And I will, if somebody needs, please reach out to me. I'll send you this slide or anything you want. I'll be happy to send it to you.
Did you already send it to me over email?
I think I sent you this
Okay.
in a PDF format. Yep.
Okay.
Yeah,
Cool.
you can share with them. Yep.
Okay.
Yep.
Well, then that's a wrap for today, folks. Thanks for joining Investing for Generational Wealth. Again, thank you, KK, for spending time and teaching us about underwriting. And until next time.
Thank you very much. And thank you very much for having me, and folks who have listened to me, spent an hour with me. Thanks for your time, and have a great evening.
Yeah. Have a great evening, y'all. Thank you.